the deal, and most people early in their career, it's about them. It's about them. And the private equity guys that have been doing this for a while, if you're smart in how you set up your fund, your deal, you don't need to ever worry about yourself. You just need to worry about your investors.
Most real estate investors spend years chasing deals, but what if the real secret to building wealth in real estate isn't finding more deals? It's thinking like private equity. Today, on the Real Estate Roundtable, we're sitting down with someone who has spent more than 26 years inside the world of institutional real estate investing and has been involved in over 2 billion, I'm saying that 2 billion in multifamily transactions. Ken G is the founder of KRI Partners, a real estate private equity firm and investor education platform helping people understand how professional investors analyze, acquire, and manage large multifamily assets. Before building his investment platform, Ken worked inside Deloitte's tax and M&A practice, then moved into commercial lending, giving him a rare inside view of how deals are structured, financed, and evaluated from every angle. Today, we're going to break down what separates private equity thinking from everyday real estate investing, why multifamily continues to outperform across market cycles, the 4 rules every passive investor should follow before investing in a deal, and how investors can build long-term wealth through disciplined acquisition. Ken, welcome to the Real Estate Roundtable.
Thanks for having me, man. I'm looking forward to it.
Every great investor starts somewhere. Ken's story begins in a world that most real estate investors never see, the financial and tax side of large-scale deals. Ken, take us back to the beginning. You started your career at Deloitte in tax and mergers and acquisitions. What originally drew you into the world of real estate investing?
Yeah, so that's a great question. So it actually happened a little bit differently. We got a little out of order there. So grew up in Toledo, Ohio, got my undergrad from the University of Toledo, moved to Cleveland, became a commercial lender for 5 years while going to school at night at Case Western Reserve after pursuing my master's degree. It was there that I decided I wanted to be a CPA, and that's what I went to school for. So I became a CPA then, went to work for Deloitte on the tax side, got all that right, and did tons of M&A work, due diligence, tax planning, anything that you could think of as fun as a CPA. I got to do it. But the reason I got into real estate actually had nothing to do with real estate. It had more to do with, I want you to rewind the clock, like a lot of years, like almost 30 years. My kids were young. My daughter was an infant. I used to do her 3 a.m. feeding. And it was really cool, right? And if you're a parent, 3 a.m. time, everybody's asleep. It's father, daughter. I mean, man, that's cool. And it was cool until it wasn't. And what happened to me was I started realizing, wait a minute, you dope. Like, it's 3 a.m. and this is the best you can do for your daughter. And it's because I was working so much at Deloitte. It's a great place to work, but I mean, you're working like a dog. So I got frustrated. I did everything right, or so I thought. I went to school, got good grades, got a great job. I should be living large. And then I just figured out, wait a minute, my family now is going to grow up without me. And that really ate at me. So this had nothing to do with real estate. But here's what led me to real estate. When I was at the bank for 5 years, all my customers were in multifamily or some kind of real estate, making tons of money. And I knew it because I was their banker. Then I went to Deloitte. And wouldn't you know it, the Cleveland office of Deloitte, which is where I was, had the biggest real estate tax practice in the firm. So now I'm surrounded by more guys, not just making millions, but hundreds of millions of dollars in real estate. Like if I told you their names, you would know their names cold. They're that well known. And I'm like, man, if these guys can figure this out, like in my mind, like they were where I wanted to be. And I'm like, all right, I got to go figure this out. Spent 18 months trying to figure it out. Back then, there was none of the Real Estate Roundtable. There was none of this stuff out there. So I had to figure it out the hard way, go to apartment association meetings. After a year and a half, I did buy 3 deals, small deals, 28, 24, and 22 units. Sold them 3 years later, made $500,000, and was like, holy, what did I just do? I cannot believe what just happened to me. $500,000 in the bank all at one time was just nuts, right? And I hung around for Deloitte for a little bit longer because I'm a pretty risk averse guy. And then I said, all right, I got to pull the plug on this because this is how I got to spend the rest of my life. And that's how I got into real estate. It actually is my daughter's fault.
Yeah. Oh, bad daughter.
Yeah, right.
She's gonna be happy when she's probably grown by now.
Oh, yeah. Oh, they're grown. And I'll close the story for you. I did not miss any of their stuff, any of their basketball games. She played AAU, traveled all over the eastern half of the country. I was there with her, right? Weekend trips in the car, man. There's no better time to spend with your kids. And so I didn't miss any of that stuff. I got to put them through school without a bunch of debt. Mission accomplished for anybody that's thinking about this. Works, man.
Oh, I can attest to that too. I'm 38. I'm living the same kind of life. So we do scouts with my kiddo on the weekends, all that stuff. It's, how
I did Indian Princess, Indian Guides. None of that would have been possible.
Yeah, for sure. You know how they say that scouts is only 1 hour a week.
Yeah, right.
And then you end up doing 20, 30 hours a week in scouts and you're like, this is a full-time job next to my other job.
But it's worth it, man. Your kids, it's important, man.
Yeah, it's fun though. It's a lot of fun to get to learn a lot, and I get to help the next generation of leaders. So you've been involved in over $2 billion in multifamily transactions. When you look back at your early deals, what lessons shaped you, and how did they shape you, and how did your approachment to investments today, change?
Yeah. So the good news is that 2 billion actually is it's a wide range of experience. I did private equity deals. I did deals when I was at the bank, 60, 80, $100 million deals when I was at the bank as an analyst and a commercial lender. And so I got a broad spectrum. Actually, early on, very little of my financing work was in real estate. It was all, when private equity firms, the typical private equity firms buy companies. They don't buy real estate, they buy companies. And that was mostly my experience. And so what happened to me was, after I started doing the real estate thing, I'm like, man, this is good. And it took me about 10 years before I started raising money from outside investors because I wanted to know what I was doing before I did it. So after 10 years, I thought, wait a minute, I understand this private equity model. We still didn't adopt the true private equity model because the private equity model raises money and then goes finds the deals. We flipped that around back then. We syndicated, just like most people do. They go find the deal and then they run around like a nut for 45 or 60 days trying to raise all the money. And so we did that for a while. And then I realized, man, this is hard. Like, this is really stressful to raise $5-10 million in 45 days. I mean, that's really stressful. So I flipped it around and I said, you know what? I was at Deloitte. I understood this private equity model. I mean, we need to do this with real estate. It's called a blind pool fund. So now we're on fund number 6, but from fund 1 forward, we raise the money and then use that money to go find the deals. And let me tell you, I thought it would work. We did it originally because we were in Florida. And when you're bidding on a deal in Florida, there's always 20 guys standing next to you bidding on them. So how does a syndicator separate himself? Pay more. Well, if you raise the money in advance, guess what? You don't need to pay more. You get the best deal.
Yeah, of course. And you can close much faster.
Well, yeah, the certainty of close is what's so important. So what's the lesson early on that I learned? And early on, it was about credit. It was about understanding how banks think, how lenders think, how other investors look at deals. Those were the most important lessons that I learned early on. And then when I stepped into raising money for myself, it made it so much easier because you're understanding the way the world is looking at you. Whereas a lot of people that start out in this business didn't have the benefit of that knowledge. And it's just hard for them to understand lenders and why they mitigate the risks they do and why they like some markets or why they don't like some. It's all of those risk mitigating credit kind of, credit calls that nobody has access to. That was massively valuable to me early on.
Oh, yeah, I can see that definitely happening. So most real estate investors think about deals very differently than institutional investors do. Can you often talk about the private equity mindset? What does that mean in practical terms?
Yeah, most real estate investors think of the deal and most people early in their career, it's about them. It's about them. And the private equity guys that have been doing this for a while, if you're smart in how you set up your fund, your deal, you don't need to ever worry about yourself. You just need to worry about your investors. And so when we help people figure this business out, and when they go out to raise money, they never understand that, wait a minute, we're trying to sell an investment to an investor. That is not what we do, not at all. So here's the biggest change of mindset, and that is we approach capital raising from the investor first. What are you looking for? What are you trying to do? Why would you want to be in this market? Why would, we're trying to line them up with us. It's more of a, does that investor's objectives line up with what we are trying to do? Most people don't do that early on in their capital raising career. They're doing it the other way around, which actually makes it hard because they're trying to sell something to an investor. What we're trying to do is we know what we do. We've got a track record. We're trying to make sure we put the right people in our deals so that, remember, we're all partners, right? We're kind of in bed together. Most, you don't know who the other ones are, but you're still in a partnership together, and everybody's got to get along. Everybody's got to be marching to the same drum. So it's that shift in mindset when you're raising capital that is the biggest difference.
Gotcha. I mean, that's eye-opening. What are the biggest mistakes you see individual investors making when they evaluate deals?
Yeah, they don't actually do the work. So, and I know I don't want that to come across as sounding arrogant, but I heard John Maxwell say something a few years ago. People want to do what you do, but they don't want to do what you did. And the did part is massive. And you don't see me at 4 a.m. when I get up to get on a 6 a.m. flight to go down to Tampa to look at a deal and look at another deal and look at another deal and then jump on the plane and come back. And then they don't see me pounding away on my spreadsheets trying to make sure the deal makes sense. They don't see me Google driving properties to make sure the neighborhood's good. See, nobody ever sees that stuff, but that's the stuff that matters. And that's where, on the educational side of our business, I am hyper focused on, I want people to be successful. There's no reason for people to lose money in this business. You just got to be educated. You just got to know and be willing to do the work and have somebody really be honest with you about what it takes to be successful. So that's the thing I want people to really focus on. It's a business. Let me ask you a question. How many successful business people do you know who will say to you, honestly, they don't really understand the details of their business?
I think if they're solopreneurs, most of them don't understand their business. In my opinion.
But I'm talking about successful people.
Sorry, what was that?
I'm talking about successful people.
Successful
people that have been able to scale companies and grow companies. They know their customer.
They know exactly from the ins and outs, from their
my point.
P&Ls, everything.
Yeah.
I know successful entrepreneurs that are basically solopreneurs. They're successful, but they don't know a lot of the ins and outs of their business, except for, if I make this phone call at 10 a.m., I'll get business at 2 p.m., and then I could close a deal. As a realtor, talking about realtors in general, when they get into real estate, they don't really get into it as this is a business. They think they're getting into a business, but they don't realize how much it actually entails to have a business, because now you're wearing marketing hat and accounting hat, and everything else under the star is your responsibility.
Yep.
So those who are a little bit of who I talk about, and the ones that really figure it out, then start building teams and then open brokerages, or vice versa, just start building a team and have a big team under a brokerage, or the other way around. And those are the guys who really know that they know their business ins and outs. They know the numbers down to every cent, where everything goes and what everything brings in.
Yeah. So the point of bringing that up is that's what I want people to do, because I want you to think about this. Would you give your money to me if you didn't think I knew the details of my business?
Probably not.
No, probably not. Back in 21, they did it because they thought only morons could lose money. Like it was impossible to lose money in real estate. But fast forward to today, people are, investors are much more careful. And so, I mean, just think about it. The only way to raise money, people always say, how do you raise money? How do you raise money? All I do is show people that we know what we're doing. We pay attention to the details. When people know that you roll up your sleeves, right? No, didn't set that up, but they roll up their sleeves and they dig in and they know what's going on and they know how to run the business. then people are like, wow, I like this. I like these people. I like what they do. I understand. I believe that they're going to really safeguard my capital. Whereas, some investors will ask a sponsor a couple detailed questions about the operations of the business and they don't know. And that's what I don't want to have happen to people, because investors now are much more careful than they used to be.
Well, I know a handful of big investors in our area that are underwater that got into properties in 21, 22, and now they're like, we can't sell because we'll lose money. As in terms of losing money, meaning that they'll have to sell for less than what they bought for. Yeah. I always look at this in a different way. And I don't know what you think about this, because it's not always about winning at the end. It's about what the whole process brought you as well during the whole process. Like you collected rents for X amount of years on, 100 units. How much money did you make there? Like you don't always have to, if you have to sell because they're calling the note on you or something, it was a bridge loan and God, now I have to sell, maybe sell at a little loss. But you already made money with this. That should be calculated, I think, into the overall, profitability of the deal itself. Yes, of course, you want to sell with a profit as well, but that's usually a caveat sometimes, So
and most people do roll that together. I agree with you. Most people do roll that together. When we talk about what kind of returns we get on our deals, we include the regular cash flow distributions as well as what happens when you sell, because you got to roll it all together. Because you just should. Yeah,
it's also income. Now these guys don't, and they're like, well, I don't want to lose money. And I'm like, guys, we're serious people here. You already made, $150,000, $200,000 a year on rental income. Yeah. That's also positive, because we get offers, my friends always tell me we're getting offers, 200 or 300 or 400 under what we're asking for, what his break even point would be. And then I'm saying, but he has to sell because his note is due. He already made that much money. So it's basically a break-even deal at this point. Yes, he didn't make a lot of money with it. No, but at a break-even deal, it's better than losing the property to a bank. Yeah. I always say that. It's like, it's better than losing it.
Yeah, agree 100%. Yeah.
So here's the next question on multifamily properties and, private equity group. What are the first three things you guys analyze before even considering, an acquisition?
Yeah. So for when we're looking at a property, when we see a property come across, it's market, submarket, neighborhood.
Okay. Market, submarket, neighborhood. Okay.
Yeah. So say Orlando, then I might, pardon me?
You don't even look at the property, what it costs, how many units. You're like market, submarket, and neighborhood. That makes a lot of sense.
Yeah. Because I can't change those things.
Yeah. It's a location. We always say that in real estate.
Yeah, but it's the why. See, you're right. That's what everybody says. And I hate that everybody just, it's location. But why is it? The reason is because so remember, I'm particularly aware of this issue because the first 10 years we grew up in Cleveland. So Cleveland is not a market where demand exceeds supply. It's just not that way. It's the other way around. So I know how to operate. I know how to go long in a bear market, right? That's what Cleveland is. It's just not growing, and it is what it is, right? So, and then I've operated in Florida. That's the other extreme, right? We go from two extremes. So I really understand what it means. So market, I want diverse. I want employment growth. I want diverse employment growth. The submarket, I need the same thing. In neighborhood, I care the most about crime. Those are the things as I look, that I call it a funnel. That's kind of what it is before I get to the property. Because if one of those things is a mess, I no longer want to do it. I don't want to do a Cleveland anymore. I can do it. We made a lot of money in Cleveland. I'm not, necessarily against it, but I can do so much more when I have the wind in my back than the wind in front of me, right? In going against me. So that's why I care about the market and the submarket. The other thing is, remember, after almost 30 years in this business, you care about diversity of your income stream. So that's why I want diverse employment. I don't want to go buy a property, even though it's in Florida, next to Disney, because I'm worried about one thing. Anything happens at Disney, I got a problem. Same thing. I love the military. Nothing wrong with the military, but I don't want to buy near a military base, because if they get deployed, I'm toast. I'm done. There's nothing I can do. Same thing with being near a college or university. Right? If they decide to build a whole bunch of new dorms and I'm relying on them for tenants, I'm toast, right? See, I like that diversity. So that's why I look at that submarket, the market issue, right? That's more of a submarket issue. And then the neighborhood matters because I've operated in tough neighborhoods. And you don't stop people from committing crimes. They're going to commit them. The best you can hope for is to move it away from you a little bit. But what crime does is people know where the crime is. They just know in the area. Oh, you're where? Oh, yeah, no, never mind. Thank you. And they hang up on you when the renters are, we know what that like. And even if I could move it out of my building, I can't change that perception very easily. So that's why I start with those three things. And if those three things line up, then I'll go to the property. Does that make sense?
Oh yeah, it does totally. It opens up eyes for some people that are just looking at numbers and this makes total sense. It's a C-class property, with high margins or possible margins. It's mom and pop operator in a bad neighborhood. You're like, yes, those are probably your biggest cash cows, but you have to be able to go through that, all the emissions and all the everything until you change the whole renter pool and then change the whole look of the building. And then it's just so much more work, especially you've been in it for 30 years. I'm pretty sure you don't want to do any heavy lifting like that. If you're new, I say, go at it sometimes because that's where you learn the most.
Yeah, but here's the thing that I want to leave people. I will tell you the number one thing. I mean, I've watched a lot of people try to figure this business out. For some reason, even though whoever their mentor is or whoever they're talking to says, don't go to a bad neighborhood, they end up in bad neighborhoods. I think it's because they don't really legitimately understand what a bad neighborhood, what that looks like, or they get FOMO. I'm convinced people back in 2120, there was FOMO everywhere. And if you know what FOMO is, I call it, everybody makes fun of me because it is fatal. There is no cure. I mean, it's horrible. Once you get it, you're screwed. You're done. Stick a fork in you. So I do think that new people in this business have difficulty equating, well, that's a decent neighborhood. And when I walk through that neighborhood, I'm like, no, this is not a good neighborhood. Why do you think it is? And because it's it's abstract. And I think what drives them is that FOMO thing. So again, I go back to this neighborhood. You cannot get good people to move into bad neighborhoods. You have to really trick them. And it's really hard to do. They just won't do it. So when you can't get the good people there that can afford to pay more rent, how are you going to raise rents? It's going to be very hard.
Yeah. And that's
how you make money in this business.
Exactly. That's where your money comes into play. For sure. Unless you're finding that mom and pop deal that are way undervalued in rents and everything. And you know that the market rents are, even in a bad neighborhood, are much higher than what they're actually at. It's just they're like tired of doing anything to the property. So you take over, you do a little renovations, and then you can raise rents. But those are the properties that are going to be hard to sell then, because a guy like you would be the ideal next buyer for it, with a fund coming in. Like, okay, we could pick that up. We're Grant Cardone style, like we just buy good properties and that's it. But it's hard to sell because now you're in a bad neighborhood. Yes, you're getting decent rents. Yes, the apartments are, fairly good looking, but the location, again, is one of those things.
No, we don't do the heavy value adds anymore. It's a joke. If you mention Grant, you know what he buys. We buy baby Grant deals.
Yeah. I can picture that.
That's what we buy because there's massive upside there. I mean, they're great properties. They're new. I'm buying them at great prices, and I can hold on to them for a long time and return everybody's money, and everybody's got a free apartment building then. How could you argue with that?
Exactly.
That's hard to argue with.
You cannot argue with that. No, I like his business model, how he does it. You got to get there to be able to do that. It takes time.
But you just had to be patient.
Mini Grant Cardones from the start, you got to get up there and experience. As you said, you had 30 years behind you doing this. So you have plenty of experience in being able to raise the money to a fund, A lot of people want to invest passively in real estate, but don't know how to evaluate operators or deals. For someone thinking about investing in their first multifamily syndication, what should they look for first?
Yeah, I've watched so many people get into this business and passive investors. I actually come up with 4 rules that I want people to follow. And some of them are going to seem obvious, but the why is what's important behind every one of these. Number 1, you got to make sure that they have a track record. You're like, Come on, of course, Ken, stop being silly. Of course they need a track record. But here's the deal. Anybody can buy a deal. You're looking for somebody that has gone full cycle on deals. Because then they've showed you that they bought, they ran, they sold, and they made money. And you can't question, did they make money or not, right? Anybody can buy a deal. So track record, but that full cycle part of it's really important because now you know they've actually done what they tell you they're going to do with their money. Number two, experience. You're like, there's another one, Ken, of course. Like, why are you saying this out loud? I'm telling you that I don't know what's coming next. We didn't know COVID was coming. We didn't know hyperinflation was coming. We didn't know rates were going to go through the roof. And now we didn't know there was going to be a war, right? We don't know what's going to happen next. So the experience needs to lie in the management team that you're investing with because they don't know what's coming next either. You just need them to have the experience to figure out how to navigate whatever is coming that you don't know is coming. And the only way you can do that is through having that management team have experience. Next, I want them to make sure that I want you to make sure they're transparent. So, for example, we do a monthly Real Deal Investor Update where we literally tell you how many leasing leads did we get that month? What's our insurance cost? What's our actual occupancy? I mean, all the real details, right? That's transparency. If all of our people I'm just giving you examples of what it looks like so that people can realize it when they see it. All of our investors have my cell phone number. If they have a question, they just call, right? They can come on the webinar and ask it live, or we could talk privately if you want. You can visit your properties anytime you want. You can tell me you're coming. You don't have to. I don't care. The manager's there. They'll show you around, right? And then we have all of our track records been vetted on our website by a company called Verivest. Paid them an insane amount of money. They literally audited our entire track record. It's on their website. You can click right through it from our website. You can see their website, what they calculated our returns, right? Like see the transparency, right? You want that firm that you're investing with to be transparent. And then finally, they've got to put you first. And this is really important, but it's hard to figure out sometimes. So you got to look at the documents and you got to say, just ask yourself, is it possible for this guy to do really well, meaning the sponsor, and you as the investor not? And the way to do that, you're looking for high fees. You're looking for weird waterfalls where they're getting paid first, stuff like that, right? Just the best way to figure it out, is it possible for this guy to get rich and the investor not do well? That's what I mean by that fourth rule. It's a little harder sometimes for people to figure out, but every time I've seen deals go south, it's usually one or two of those rules were broken. And, back in 21, everybody wanted in. Everybody thought, you can't lose, man, just go do it. And there were a lot of people that really got into the business, didn't know what they were doing, wouldn't roll up their sleeves, wouldn't figure out the details. And they're well-meaning people. They just didn't know. And everybody thought, well, I'm just going to give this guy the money because he's willing to do some work. But they just failed because they didn't know. They didn't know what they needed to know. So those are my 4 rules. They're mine. I came up with them. There's nothing fancy, but if you just apply them, they work.
Got you. Now, what are the biggest red flags passive investors miss when evaluating investment sponsors?
What's the what? I'm sorry?
Biggest red flags that passive investors miss evaluating investment sponsors.
Yeah, that's a good question. So here's what they miss. Most people are afraid of being offensive. So they just want to be polite people, right? And so what happens then is that internal, they're nice people. They don't want to offend the sponsor. They're afraid to ask detailed, pointed, direct questions. That's the number one thing that investors, I think, hurt themselves because they're worried. They don't want to offend. They don't want to be the pain in the ass guy. And therefore I might not let you in my investment. No, here's the reality. Investors need to ask operators detailed questions. Hey, let me ask you, how are you staffing this property? I'm just curious. Mm-hmm. And then wait for the answer. And they need to have a good answer. Why do you think you can raise rents? Walk me through that. Tell me exactly what shows you I can raise rents, right? So some investors think that's going to offend the sponsor and they don't want to go down that road, but that's your only defense, right? That's your only defense. You got to ask this guy or gal questions. And the more detailed questions, the better. I love it when people ask me questions because the smarter you are as an investor, I know you're going to be a better investor because I know what we do and remember I told you raising money, we're always trying to make sure the investor's right. We
Hmm.
don't want an investor who really misunderstood what they thought they were investing in. That's a train wreck, because now once you're in, you can't get out, right? This is real estate. It's not ATM. You can't just go up there and key in your code and get $200. I mean, that's not how it works. So I hope that, I know that's a long-winded answer to your question, but I'm feeling pretty strong about that. That's it.
What's the number one reason people hesitate before their first investment?
Oh, well, yeah, that's, so you're talking about passive investors.
Yes,
So,
correct.
yeah, so it's less now than it used to be. So, in the beginning, after that Jobs Act made it all possible for this whole industry to kind of grow up, it wasn't very mainstream to invest in these private deals unless you're a wealthy person at the country club. You don't even know about them. Well,
Mhm.
now so back then it was not very well known. So people were just like giving 100 grand to one guy. I don't like that. Now that is less so. Now they're much more comfortable because it's come so much more mainstream. Now the issue is, we talk with most investors, is they've actually gone and done a deal and lost some money because they didn't do their due diligence up front. And so now they're doing it much better now, which I'm thrilled about.
Oh, that's great news, finally.
Yeah,
I think Bigger Pockets got to all of them.
it
It's one
did.
of those. I love that podcast. That's what I started with. I'm just
Yep.
like, watching them, listening to them, and do this, do that, and just following through what they said. I did the same things, and we got into real estate investing. So I think
Good
it's,
for you.
it's a great kind of like little boost in the beginning. I hope somebody will listen to my podcast one day and say the same thing.
I'm sure they
So
will.
real estate cycles come and go, but
Yeah.
multifamily continues to attract institutional investors. Ken,
Yeah.
why has multifamily remained one of the most resilient asset class in real estate?
Yeah. This is my opinion. I can't think about this. You show me how to make it go away. You can't. I can't figure out how to make it go away. So if I can deliver 15, 20, 25% annual returns to an investor with an asset class that I can't figure out how to make it go away, like I can figure out how storage could go away. I could figure out how office could really get killed. Retail, same thing. Medical, I can make a case for that. I can't figure out how people don't need a place to live. And so I figure that if they don't need a place to live, their money doesn't matter because we got really big problems,
Yeah.
right? I mean, that means we are not here
So
if
basically,
we don't need a place to live anymore.
you can't make it go away in any kind of shape or form, and that's the reason why you think it is the number one investment in real estate.
Well, I mean, there's probably a lot of reasons. I mean, it's easily understood. Most people have lived in an apartment building and they understand it, they get it. Unfortunately, one of the reasons is because people are misled a little bit. They think it's passive. I own this apartment building. It's my passive investment. There is nothing passive about what I do every day.
It's
Okay.
nothing.
This is nothing. We got 45 people that are out there running around working like dogs, doing their thing. And it's not passive to any part of us. So that is part of what I think it is. But when I talk about this all the time, show me another investment that has cash flow, that appreciation on the underlying asset, and the tax benefits that we get are just ridiculous. I mean, how, and let me think about this. Think about the private equity model now. Again, private equity buys companies, they grow those companies, and then they sell them for a profit, right? When that company they buy has another $100 in sales, $100 doesn't drop right to EBITDA. You agree? It's some maybe $20 of it does, right? Well, let me ask you, in multifamily, here's the gold right here in my business. If you're living in one of my apartments and I raise your rent $100, how much did that cost me? Zero. The $100 falls right to the bottom line. Now it's going to be a little bit of management fees. There's a little bit of friction there, but mostly it all falls to the bottom line.
Well,
And
tax.
here's
Yeah, that's it. Exactly. Pretty
so
much.
so I raise rents. It didn't cost me anything. Falls to the bottom line. Now so everybody gets excited about this cash flow, but I'm here to tell you, cash flow is not why you're buying real estate. You think it is. I can see the look on your face. You're like, what is this guy talking about? Here's why. For every dollar in new cash flow I get that property to generate, it's worth about $18 to $20 in value. It trades at about a 5 cap, right? A 5 cap, 5% cap rate is a 20x multiple. So when I drop $1 to the bottom line, that's worth $20 in value. Drop 100,000 to the bottom line, right? Think about this. I always use this example. You have a 100-unit building and you own it for 5 years and you're able to move rents $300. You do all the math. That's 360,000 in new cash flow. You're thinking the cash flow is gold. Yeah, but that's not where the money is. Divide that by a 6 cap. What do you get? $6 million in value. See, the money in multifamily is in the appreciation. The money in private equity, when they buy companies, is in the appreciation. It's not the cash flow. That's why I say, yeah, we distribute cash flow because investors want it. The best use of that money is actually to reinvest it in the property as long as you're able to raise rents, right? So that's massive money. I mean, massive. That's why you're in this business. And most businesses don't trade at a 20 multiple. They just don't. Not small, privately held, right? Your 100-unit property. I mean, if you had a business that big, it would not trade at a 20 multiple. It just wouldn't.
That makes a lot of sense. How does financing strategy affect long-term returns in apartment investing?
Yeah, we use about 65% debt. That's it. Somebody, people are like, why wouldn't you use more? Because I don't want to, when you fall in hard times, you just don't want to lose your building. You just don't. Don't put yourself over leverage your deal. If you over leverage your deal, then you're going to have a problem. You risk losing it. If you're not over leveraged and, market softens like it is right now, that's cool. I'm okay. I still got plenty of room to pay my debt and so on, so on and so forth, because I didn't leverage it. Usually you just have to look back at history. If multifamily is struggles, it's only because of the credit. When debt is when credit is difficult, which it kind of is right now, when that happens, the real estate suffers temporarily because it's a capital intensive game. You just got to wait through it. Just wait through it. It'll come back and rents will continue to go up. I mean, you show me, unless you're in a bad market, like I've been, Cleveland rents have not moved that much. Youngstown rents, you've probably never heard of Youngstown. Those rents, they just don't move. So that's why, now you see why I care about market, submarket, neighborhood.
Yeah, I'm in Florida, so our rents are wild. I mean, we've been having a little sticky year last.
They're flat. They're flat right now in Florida.
Yeah, exactly. We were able to 21, 22, 23. It's just all the rents.
Oh, yeah, you couldn't find the top. Yeah, you couldn't find.
You have to drop rents when you're advertising to be able to rent out the places. So it's still making money. It's just not.
Yeah, that's the builders. The builders have done that.
Oh my God! And I'm in Daytona, my friend, and we have 6 new complexes in Daytona around the same area, and they're all offering 1-bedroom, beautiful units with amenities. Everything, 2 months free rent, $1,350 a month. I'm like, I can't compete with that. I'm like, if I would be competing with that, I'd be giving my property away. Literally. But they have so many vacant properties that they're just crushing the regular investors all around the area. Yeah,
you're not wrong. They did. I mean, I watched them build that whole 95 LPGA Boulevard area.
That's the area.
Yeah,
exactly.
Yeah, no, I know exactly what you're talking about. So you asked me about leverage. That's why you don't over leverage, because these builders will lease up. They will. And the properties can't continue to give away too much. You just have to survive through that period. And I don't know why, but builders, they do this every single cycle. They do it over and over. Now, the problem is when rates were down where they were in 21, they went nuts. I mean, nuts, because money was cheap. Yeah. And so they could make economic sense. And they all went absolutely berserk building. I'm thrilled to tell you, thrilled to tell you that my research shows that new starts coming out of the ground in Florida are down 70%. They had to be. So they delivered, what was the metric here? They delivered more units in 24 and 25 than they had in any single year since the 80s. Like, that's nuts. And so they dumped all this new inventory. You got to let it get absorbed. Luckily, you're in Florida, right? We're in Florida. That demand is going to fill that up. It's going to absorb it. And the builders just had to stop. And for the most part, they are. And that's what has to happen. So you'll be fine as long as you're not over leveraged.
I'm not over leveraged. I have a really low mortgage payment. I have, most of my units, I'd say I have like 90% occupancy. So I'm pretty good. It's just like, I always have this like 1 or 2 units. I'm like, what the hell? I can't rent these out. It's like,
Yeah.
6, 7, 8 months. And I'm like,
No, just do what you got to do. Just suck it up and give a free month away or something. Just get them leased.
yeah.
Just get them leased. That's what we do.
So biggest opportunities in the next 5 to 10 years, where do you see them?
Oh, right now, I'm trying to buy everything I can find right now because I think this isn't as bad as 08, 09, but I've not seen it better since.
Yeah.
I mean, there's a lot of people that need to sell for a lot of different reasons. And that's when we're a private equity firm with money raised, we have a massive advantage.
Okay, so right now, at the
Right
end of the
now, I am trying to buy everything. Yes.
buy
Right
now.
now. Yes.
I've been telling all my clients, it's like last year, when was a good time to buy? Now, buy now, because nobody else is buying, so we can get everything on the moon, when we go in. I mean, I'm a residential, mostly a real estate agent. So it's the same story. It's like, when do you buy? When nobody else is buying, because that's the best time to buy. When everybody else is trying to sell, but nobody's trying to buy, is you can go in and negotiate deals. I mean, it's insane what you can get. I'm not talking, slam dunk half price properties, but I'm talking you can get your agent's fees paid. You can get everything fixed on the house. You can get $10,000, $15,000 towards closing costs and get a little discount off the top too. And you're buying the house that's worth, $320,000 for, if you look at all the numbers adding up at 260. So you're getting a pretty good, 25% discount on a home.
Yep.
That's going to go away because, Florida, once we flip over to the seller's market, those sellers are going to be aggressive, and they're going to take everything instead of giving everything.
Yeah. That whole Daytona market, that's going to, it's if you watch Florida grow up, you watch a market, like we have a property in Winter Haven, our rents are up $660 a month since we bought it 8 years ago. 600, I mean, that's double.
Yeah.
That's double, right? So what happens is people can no longer afford it because so many new people come, drives up rents, people can't afford it. The people that can't afford it leave, they go next door to a lower priced. Then that happens. They just keep getting pushed around. I'm watching this happen for the last 15 years in Florida, and it's happening right now in Daytona. We love to be all along 95 and I-4. If we can stay as close to that, our last deal was right on I-4 in DeBerry. That whole area is growing up, and Daytona is going to do the same thing.
We'll need to talk after this interview because we have a bunch of properties we're looking to offload. At least my buddies that are really into commercial, multifamily, hotel, motel.
Yeah.
Yeah,
we're here.
We have quite a bit. So they're always like, Lance, can you help us offload this stuff? I was like, yeah, I'll talk to some people, Yeah,
I know somebody. Yeah, we got the money in the bank. We can help them.
Yeah, let's figure something out.
And we're fair to deal with too. We don't throw our weight around. Yeah. We don't.
So at the end of the day, most investors are chasing the same goal, financial freedom. You often say that knowledge builds confidence and confidence leads to action. What knowledge do investors need most right now?
They got to understand their investment. You spend a minute and learn the business so that you can then, if you don't want to do the work, that's cool. Partner with guys that do want to do the work, invest in those people that do want to do the work, but you've got to learn. If you understand the business you're investing in, you're then able to figure out who else knows the business that you're thinking about investing with them. Does that make sense?
Mm-hmm.
I mean, if some people are just good at BSing, right? And an investor asks a detailed question of a sponsor and they're really good at that, they can make it sound like they know the answer. But if you know the business, if you do, and now you're looking at, a pro forma, you're like, this is ridiculous. You just know. So that's the thing I want passive investors to do is educate yourself because, look, when I talk to investors who got in, they just assumed everything was going to be okay. And now they know, they've learned, they've gotten to understand the business. They're like, wow, like it was so obvious that I shouldn't have done this. And that's what you want as an investor to avoid. You can save yourself a lot. Just invest a little bit of time, energy, even maybe money in learning what you're trying to invest in. That's why I don't trade the stock market because I don't want to learn it. I don't like it. It's unpredictable. But people say, oh, I make a killing in the market. You're crazy. I'm like, okay, but that's your thing. I don't want or have the time to do it, so I'm going to do my thing,
Yeah.
right? And know it.
I also say, and I think this is a good knowledge for all the investors out there, don't be stingy if you find someone good. Don't be stingy if you find someone good, because if you find someone good and you're negotiating your butt off, there's other people that are negotiating with that one good guy as well. Believe me so. And he's going to go with the best bid probably out there to work with. And
Yeah.
I'm talking, this is from a real estate agent standpoint, like they always like.
You mean you don't like getting beat down on your fees?
No, and I don't even like.
No.
This is the thing. If you've been doing a lot of deals with me, I'll give you a discount on my own. But that's my call, not yours.
Yeah.
That's my call because I know what I'm worth, and I know what my. And that's the thing. Like I'm always out there and saying, like I know my worth. Look, I'm out there drumming up business all day long. We have X amount of listings. We have millions and millions of dollars of real estate to sell. That means that I don't really need your business as a per se, person with a listing or a person as a buyer. I can go out and find someone else. So my fees are my fees. If you want to get access to my stuff or to me, you got to pay my fee. If you know what I mean, like a good agent is like that. They're not going to discount themselves. Of course, you're coming in with $100 million deal. I'll take a a smaller fee on that. I'm not going to say that it's going to be the same on every single deal. But if you're, if you're buying, smaller stuff, and that's most of the new investors out there is like, hey, can you help me with this? Can you help me with that? I'm looking for this. I'm looking for that. And you work your butt off for someone like that. And then they would never pull the trigger. So it's like, hey, my upfront for an investor is you could put $1,000 in a deposit for me. And then we can start talking.
1,000?
Well, just to start off.
Not even a lot of money. Yeah,
it's not. But they don't. Most of them like, what do you mean I have to pay up front? That's their answer. I'm like, I know that my time is worth a lot more than what you think it is. That $1,000 is just to see if you say yes or no.
Yeah.
Because most of them say, oh, what do you mean? Can we do 500? And then they start negotiating on that. It's like, nope, sorry, I'm not going to work with you. That's like, but the people that say, yeah, sure. They are the serious guys. They actually know what they want, and you know that it's going to come to fruition at the end.
Who tend to negotiate. They think they're negotiating against the other person, but what they're actually doing is hurting themselves. Because if the person you're working with isn't happy with what they're being paid, they're not going to give it their all.
Oh, yeah, exactly.
You hurt yourself.
Yes.
Being penny wise, pound foolish. That's what we call
it. Rapid fire closing questions.
Yeah.
Get short answers, okay?
I promise. I will do it.
Before we wrap up, I got 3 quick questions. What's the best real estate investment advice you've ever received?
Yeah, the market. You got to pay attention to the market, the neighborhood.
Okay. What's one book every investor should read?
I'm going to take it beyond investor, and I'm going to say Cardone's 10X, because that's what business is. It's way harder than you think it is.
And what's one trend in multifamily investing people should be paying attention to right now?
Yeah, it's the oversupply. This is when you have to buy. I'm absolutely convinced of that. Now, oversupply is when you buy. Ooh, I just made that up.
Oversupply is when you buy, guys. I love that.
I just made that up, but it works. Yep.
You have to put it in a frame above your head in the next podcast.
I will.
Ken, this has been fantastic conversation. If there's one big takeaway from today's episode, it's that successful real estate investing isn't about chasing deals. It's about disciplined thinking, strong underwriting, and understanding how professional investors evaluate opportunities. Kenji has spent more than 2 decades inside the world of institutional real estate investing and has been involved in over $2 billion in multifamily transactions. And today he shared exactly how investors can think smarter about building long-term wealth. Ken, if people want to learn more about you or connect with KRI Partners, where's the best place for them to go?
Easy, KRIPartners.com. KRIPartners.com. Just go to our website and then reach out to us. We'll take care of you.
To everyone listening, we'll include links to Ken's website and LinkedIn in the show notes underneath the video. And if you enjoyed this conversation, make sure to subscribe, share this episode, and leave us a review, because every week we bring you conversations with experts shaping the future of real estate Until the next time, I'm Lancelot Lenard, and this is the Real Estate Roundtable. Thank you for listening.
Thank you for joining us on Sir Lancelot's Real Estate Roundtable, where we've unveiled the mysteries of real estate together. Remember, in this kingdom of possibilities, every dream home is just a discussion away. I can help your real estate dreams come true. Just call me at 786-449-7518. Until our next roundtable, may your ventures be prosperous and your homes be filled with love and joy. Farewell, fellow knights of real estate.